This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Brexit on the brain. Why tomorrow's UK vote on whether to leave the European Union has investors here on pins and needles. Stressed out, the Fed will tell the banks if they're in good shape. Investors want to know if they're healthy enough to hike their dividend payouts. And Old Reliable, the surprising name topping one of the auto industry's most prestigious lists. All that and more tonight on Nightly Business Report for Wednesday, June 22nd. Good evening, everyone, and welcome. Sue Herrera is off this evening. An evening, a big evening, before the day that Britons go to the polls to decide whether to stay in the European Union or quit. Pre-vote opinion polls wobble back and forth. Right now, it looks like a dead heat, with both sides commanding about 44% of the probable vote. But 12% remain undecided. And in those undecided hands lie the future of an organization that dates to 1957. Britain joined in the 70s, and an organization that has never, ever had a member pull out. Investors around the globe have tiptoed around the vote. Today, U.S. stocks had modest moves lower. The Dow Jones Industrial Average lost 49 points to finish at 17,781. NASDAQ Composite dropped 10 to 4833, and the S&P 500 dipped about 3. Since no nation has ever left the EU before, no one knows for sure what the economic impacts could be if Britain pulls out. But what is certain is that economies around the globe, not just in Britain or Europe, could feel some tremors, some dislocation. That's a fact not lost on Fed Chair Janet Yellen, who has weighed in. So what might the vote's impact be on the U.S. economy and markets? Sarah Eisen tells us from London tonight.
Voting begins tomorrow in what British leaders are calling a once-in-a-generation vote. The results will be felt far outside the UK, including potentially on the U.S. economy. The UK is America's 7th largest trading partner. We export about $57 billion worth of goods to the UK and import a little more than that from the UK, mostly cars, medicines, alcohol, and other big auto parts. Now, when it comes to the portion of overall trade for the U.S., the UK represents 3%. So it's not a huge chunk of our trading activity. Still, if the British economy does decline, if Britain votes out, it could hurt a key source of demand. Several economists, including most notably the chairman of the Federal Reserve, is concerned about the fallout.
It would usher in a period of uncertainty, and it is very hard to predict, but there could be a period of financial market volatility that would negatively affect financial conditions and the U.S. economic outlook. That's by no means certain, but it is something that we will be carefully monitoring.
The other impact could be a weakening of the British pound if Britain does vote to leave. Hedge fund manager George Soros, who has a pretty strong track record betting on the British pound or against it, made $1 billion back in 1992, says we could see a 20% devaluation for the pound if Britain leaves. That would mean a much stronger U.S. dollar and could be painful for any multinational American company that does business here in the U.K., already suffering from the effects of the stronger U.S. dollar. But the real concern for the U.S. economy is financial market distress, widening credit spreads, falling stocks, the strengthening dollar, buying of safe haven assets like U.S. Treasuries. That's what economists fear could end up ultimately hurting the U.S. economy. It doesn't help that the economy already doesn't have much of a cushion. We're barely growing 2%, and the Fed is already working hard to keep the stimulus flowing and interest rates low. That's why another key reaction is certainly going to be European stocks and the euro, because in that case, we're talking about a $16 trillion economy, just about the size of the U.S. For Nightly Business Report, I'm Sarah Eisen in London.
And while we brace here for a possible exit, Julia Chatterley tells us, regardless of the outcome, few doubt there are major changes coming for the entire European Union. She has more from Brussels.
Here in the heart of Europe, Brussels, We can now only wait to see what UK voters decide. Will they decide to remain within the EU or will they decide to leave? And I can tell you the polls are still so close that it's anyone's guess. We have heard from the likes of Wolfgang Schäuble, the German finance minister, saying no matter how UK voters decide, Europe will be materially changed by these events. You know, I think that's little comfort to the skeptics in the UK who say, why wasn't Europe more forthcoming when Prime Minister David Cameron was trying to renegotiate this relationship in order to improve his position in this referendum fight, and actually wasn't given that much according to those UK voters? We've also heard from the president of the Eurogroup, Jerome Dijsselbloem, who said, look, talking about closer integration in Europe now just won't fly. And he's right. And it's not just about the UK, it's about the Dutch, it's about the Finns. It's also about the southern European countries who've been through bailouts. I'm talking Italy, Greece, Portugal and Spain. And for investors here, the UK is just one brick in an entire wall. And if that is pulled away, what about other wobbly bricks? I'm talking France maybe too, given the prevalence of the far-right National Front there. So while this may be a pivotal moment for the UK and their relationship with the EU, the echo boom that it creates could be far bigger for Europe, and investors will judge that early on Friday morning. For Nightly Business Report, I'm Julia Chatterley in Brussels.
The results of the voting in the UK will begin to come out overnight tomorrow night. That's early Friday morning here in the U.S. Most experts believe there will be a strong impact felt by markets across the world, no matter what the decision is. Here in the U.S., Federal Reserve Governor Jerome Powell says the U.S. Central Bank is ready for whatever happens.
Markets have been very responsive to changes in the polls, clearly, so the vote could certainly bring on significant volatility. If that happens, financial conditions could tighten. It could have an economic effect on the UK and the EU, and we would feel that as well. We could very well feel that if there were, a significant risk-off move with the dollar up and credit spreads out and that kind of thing. So we would have to take that into account in setting monetary policy.
Despite Mr. Powell's reassuring tone, Federal Reserve Chair Janet Yellen, in a second day of testimony up on Capitol Hill, had to remind the House Financial Services Committee that stock markets are not figuring into the Fed's decision-making process.
It is not a third pillar of monetary policy.
Right.
We do not target the level of stock prices. That is not an appropriate thing for us to do.
Home resales rose last month, meantime, to a 9-year high, suggesting that the housing market is strong. Sales of existing homes rose nearly 2% in May to an adjusted annual rate of more than $5.5 million. That's the highest rate since February of 2007. At the same time, the National Association of Realtors says the median existing home price now sits at $239,700. That is the highest on record. Well, today, Hillary Clinton and Donald Trump took their shots at how to fix the economy and naturally took some shots at each other. John Harwood joins us from Washington. It was a little bit of tit for tat, I suppose you would say. Mr. Trump firing back in a very personal way against Mrs. Clinton. She, not so personal today, but she had been yesterday.
Tyler, Hillary Clinton had taken 2 roundhouse punches at Donald Trump in the last couple of weeks, one on national security, saying he was temperamentally unfit to be president, and one of them on the economy. That was this week, and talking about how his business experience is mostly about Chapter 11. Today, Donald Trump, who's had a rough couple of weeks in general, fired his campaign manager on Monday, came back hard, trying to get on offense, said he was the candidate who could change and shake up Washington, shake up the special interests, and Hillary Clinton wasn't. Why? Because he argued she's corrupt. He talked about the big speeches she's given to Wall Street firms, the money the Clinton Foundation has taken, all that list of issues he went through trying to hurt her badly.
He has been trying to portray her as too tied, as you just mentioned, to special interests, getting paid for speeches, and that he's not. Do the facts bear this out?
Well, not really. Look, Hillary Clinton and Bill Clinton have raised a lot of money over a long period of time. But they've been in public service. Hillary Clinton started at the Children's Defense Fund. Her career has not been principally about making money, although, like many politicians, she has made a bunch after she left as First Lady, and Bill Clinton, that is, after he left as president, and then when she left as Secretary of State, they've made a ton of money giving speeches. Now, there's no proof that they've been corrupted by that money, but Bernie Sanders made the argument that it was corrosive to the idea of changing Washington, so Donald Trump picked up that theme.
Mr. Trump has campaigned on a very dramatic tax cut. What do the numbers say about what it would do to the deficit?
Well, the numbers say that if you ask the Conservative Tax Foundation, even after assuming the so-called dynamic effects of growth, it would add $10 trillion over 10 years to the deficit. Donald Trump has not identified a way to pay for that. Now, his contention is that the growth would be greater than the tax foundation has estimated, and he wouldn't have a deficit at all. But other think tanks, Tax Policy Center, has said similar things about $10 trillion loss to the Treasury. So there's no question that Donald Trump, given his spending promises and his tax cut promises, would, at least in the short term, for some period of years, add to the deficit.
All right, John Harwood, thank you very much.
You bet.
Tomorrow, the Federal Reserve will tell the nation's biggest banks and shareholders like you whether their plans to stand up to the financial shocks are strong enough. And investors will want to know if they can raise their dividends. We'll take a look. House Speaker Paul Ryan today rolled out a Republican health care agenda. The plan would repeal the Affordable Care Act, but would keep portions of it, such as not being denied coverage for pre-existing conditions and letting parents carry their children on their insurance until they reach age 26. It would also add long-held Republican positions like expanding health savings accounts and buying insurance across state lines. Well, the biotech sector got a strong lift early in the day after a report on Medicare spending showed the growth rate did not top its target, which would have triggered cost cuts. Jason Colbert is Maxim Group's Senior Managing Director and biotech analyst. Mr. Colbert, welcome. Good to have you with us. And I hope I'm pronouncing your name correctly. There's another guy who's got a name like yours, and he calls it Colbert. You know who I'm talking about.
I do. Thank you so much. You have it perfect.
He's funny, and I'm sure you're going to make us all laugh because biotech's moved up today on this news. What does it really mean for the future of this sector?
Well, right now the sector is climbing the wall of worry over pricing. In fact, there's been a lot of discussion on your show about the UK and what will happen. And the UK's insurance government agency, NICE, really just refused to offer a very high reimbursement rate for a new cystic fibrosis drug from Vertex. So it tells you that when we look at, will Medicare be around? Will it be able to fund our retirements, our healthcare needs? There was a report that was going to deal with drug pricing, and that report looks like it's delayed. So it looks like we're going to see no action. And right now, no action is good news because the fear is that we will see price controls in this country someday.
Are there drugs that you're aware of that are in the pipeline or soon to come to market that will be extraordinarily high priced, like the ones that treat hepatitis C that came out in the past couple of years? And how burdensome might they be? And I assume those are the ones that Medicare would be targeting if they're concerned about holding the line on cost.
That's exactly right. So when we look at kind of the new genre of biotechnology drugs, they're personalized medicines around gene editing and something called CAR-T. They're extraordinarily expensive, anywhere from $200,000 to maybe even $1 million a person. How are we going to pay for that? And so that concern is now rapidly starting to creep into the marketplace as the reality of these drugs gets closer in terms of their clinical maturity and the years away from being commercialized. Something's got to give. We can't pay for everything.
It's really a very, very difficult ethical question when you start to look at cost versus benefit in this area, because obviously each patient is individual. and the prices can be very high. Take us through that thinking very briefly.
Well, a great example is the Nice decision on the reimbursement of the cystic fibrosis drug that Vertex manufactures. What they found is a very small, very short incremental benefit against a very high price target, and the government decision was made not to reimburse it. It's funny, but governments all around the globe, in Japan and Europe, are able to regulate price controls and say, what is the risk, what is the benefit, and what is the aggregate benefit to society? That's something that our healthcare system has never been able to deal with, and yet we're going to have to deal with it, because when we look at the Medicare trustees report, we know that Medicare is just not funded to pay for everything. So again, something's got to give, but who has the political will to deal with it? And in a political election cycle, that becomes an even more prominent question.
Jason, thank you very much. Very clear, very helpful. We appreciate it. Jason Colbert of Maxim Group. Well, investors give the thumbs down to Tesla's bid for SolarCity, and that is where we begin tonight's market focus. Last night, the automaker made a nearly $3 billion takeover offer for the rooftop solar energy company, another company founded by Tesla's CEO, Elon Musk. Mr. Musk says the deal would be allowing customers to buy an electric car and a home solar system in a one-stop shop. Shares of Tesla cratered more than 10% to 196.66. SolarCity shares rose 3% to 21.88. Shares of Winnebago got a lift today after the RV and motorhome maker reported a jump in quarterly profit that topped estimates. Revenue also rose better than expected thanks to an increase in sales in the company's towables and motorized shipments businesses. Shares up 6% on the day to 22.95. Analysts are bullish on Priceline. Barclays upgraded the travel booking company stock from equal weight to overweight and increased its price target to $1,500. Yes, you heard me right. The firm cited an expectation that Priceline will see long-term structural growth and improving margins. Shares of Priceline up 1% to $1,360.10. But it's a different story for McDonald's. Nomura downgraded the fast food chain stock to neutral from buy, citing overall slowing in the U.S. burger restaurant sales and tougher year-over-year comparisons. Shares of McDonald's off more than 1.5%. On that news, they finished at 120.62. Well, tomorrow the Federal Reserve will release the first round of the so-called stress test for the big banks. The purpose is to see if the banks have enough capital to handle a sharp economic downturn. Investors will look to see if the banks are strong enough to raise dividends. Joining us to talk more is Eric Oja, analyst at S&P Global Market Intelligence Equity. Eric, good to have you with us. Some of the banks, and I am remembering most particularly Citibank, have had stumbles when these stress test results have come out in the past. Is Citi the one that we should watch closest tomorrow?
Well, I think the ones that we should be watching would be the largest 6 banks in the U.S., which would also include J.P. Morgan Chase, Bank of America, and the custody banks, including Bank of New York Mellon and State Street, because the stress tests have a new level of complexity tomorrow, which would be counterparty risk in a global environment. And as well, there's also how would they react to negative interest rates. So the stress tests will be tougher tomorrow, and certainly Citigroup will be in the crosshairs of that.
Are these banks healthier now than they were, say, 3-5 years ago? Not just with respect to being able to pass a test, but just healthier generally?
Sure. Revenues are up. Capital ratios are up. Liquidity is up. They've done a great job in the last 5 years of making themselves much stronger. And I would say that the U.S. banks are amongst the strongest banks in the world now.
Do you anticipate that when these results come out, that any of the banks you mentioned will be restricted in their ability to pay or raise dividends to the levels they might like to do?
It's likely that Bank of America and Citigroup will still feel some restrictions. Likely most of the banks will not be able to have the sort of dividend increases that we have seen in prior stress test cycles, simply because they're getting to the upper end of their payout ranges. They can't really pay out that much more as a percentage of profits, and profits are not growing as fast as they were during the early part of the recovery. So it's likely that the largest banks will be constrained. We expect that most of them will have some small increases.
All right, Eric, thank you very much, and we'll all be watching with great interest tomorrow.
Thank you.
You bet. Thank you. Coming up, J.D. Power out with the most reliable brands for automobiles. Did yours make the list? Here's a look at what to watch tomorrow. We get our weekly snapshot of the labor market when initial jobless claims come out. More housing data. This time it's new home sales for May. The existing one's pretty good. And as we've been talking, the big UK referendum on whether to leave the European Union. That's what to watch Thursday. Well, here's some welcome news for car buyers. A new J.D. Power survey shows that owners report fewer problems with their new vehicles, especially when it comes to infotainment systems. Phil LeBeau takes a look at what's changed and which brand is rated now as most reliable.
After years of steadily improving the reliability of its new models, Kia has become #1 in new vehicle quality, according to the research firm J.D. Power. Kia topped this year's survey, edging out Porsche, Hyundai, Toyota, and BMW. It's the first time since 1989 a non-luxury brand has topped the reliability survey. Researchers say it's due to Kia focusing on cleaner model launches, where automakers often struggle with issues that can pop up unexpectedly.
So the new vehicles that are coming out are really coming out launched very well thought out in the design phases of their vehicle.
Overall, the auto industry is doing a better job cranking out new vehicles with fewer problems, especially when it comes to infotainment systems that have been the #1 complaint with new car buyers. In many cases, the connectivity doesn't always work, or there are glitches in the electronics. But that appears to be improving as automakers focus on giving drivers in-car options that are easier to use. Amy Nelson in Western Springs, Illinois, says her new Land Rover has the connectivity she wants without overwhelming her.
The appeal to me was that it didn't have all the bells and whistles, and so it was kind of simple and clean on the inside and was a good fit for me.
While Kia may be the automaker with the most reliable new vehicles, according to J.D. Power, there's also good news in this survey for the American brands. For just the second time in the last 30 years, the big three all improved their reliability in the same year, with the biggest gains coming from Jeep and Chrysler. Phil LeBeau, Nightly Business Report, Chicago.
Cannes Lyon was always one of the big get-togethers for the advertising world, but now it is turning into a kind of South by Southwest type of event in France, where different media worlds meet. Kayla Tausche takes us to the south of France.
Cannes Lions started as the advertising industry's response to the Cannes Film Festival, but it's really morphed into a who's who of the tech and media world as all of those worlds have collided. You have the legacy broadcasters touting their foothold in digital, while hot young upstarts like Vice and Snapchat are touting their expansion and momentum.
It's a good time to expand. Millennials just took over from baby boomers as the largest cohort in the world, and we're a millennial brand, so there's a lot of demand. So we just announced 50 new networks around the world, 50 different countries.
With conference goers buzzing about the future of Viacom, Sir Martin Sorrell, chairman and CEO of WPP, which is a client of Viacom's, as well as his wife being on the Viacom board, we got his take on how he sees the situation unfolding.
We have a relationship with Viacom, a significant relationship with Viacom in terms of we're buying media on behalf of our clients.
Does that relationship depend on Philippe Darmon remaining CEO? What do you expect?
No, it depends on the value that Viacom and indeed any other television group delivers to our clients.
Facebook's ad chief announcing Instagram hit a milestone of 500 million monthly active users.
The exciting thing is that this last 100 million have joined faster than the prior 100 million. So we're seeing tremendous momentum around the world and enthusiasm for a platform that is all about visual communications and discovery.
Not to be outdone, Twitter's COO Adam Bain voicing optimism for his company's product pipeline amid growing criticism.
We're excited about video because video is great for people on Twitter. It's great for publishers that put content on there. And certainly it's great for marketers. It's a terrific creative canvas for advertisers, and ultimately on the ROI side, we've shown that advertisers get better returns when they use video in their ad campaigns than even traditional promoted tweets.
An eventful week that may only look like a day at the beach. Executives say it's one of their most productive weeks of the year. Most conversations about deals start here. For Nightly Business Report, I'm Kayla Tausche in Cannes.
I would call it my most productive week of the year, too, if I wanted to go back. All right, finally tonight, who says people don't like a front runner? In this election year, politicos are having an impact on baby names. According to an analysis of more than 115,000 baby names registered by the website Baby Center so far this year, names from the Clinton and Trump families are on the rise. Hillary far in front, up more than 140% from last year. Donald up 8%. Oh, in the name of runaway Broadway smash Hamilton, it's up 60% as a baby name. That's Nightly Business Report for tonight. I'm Tyler Mathisen. Thanks for watching. Have a great evening, everybody, and we'll see you back here tomorrow.